Very warm welcome to you, Jelly Bean. I have this beautiful, fantastic website called uniswap.fish, and it's going to be so useful to demonstrate the lessons I have for you today. You know, on Pulse Chain, we have yield farms out here, and everybody is new to this concept of yield farming. There is V1 and V2, right? So by the time I'm recording this, you can see V1 and V2. Maybe in the future, there might just be a V3 that combines them all. So what happens is whenever someone trades, I'm going to show you right now, baby dolls. Whenever someone trades with you, they basically pay you a fee. So if you're providing liquidity, if you have two coins here, we have Pulse and PulseX. If you have these two coins here, you provide liquidity. When people want to swap between them, they pay you a tiny little fee. On Uniswap, it's 0.3%. The fee starts to morph with the new updates and it becomes a bit more complicated, but we can just use a very, very simple amount. So if you did 0.3% and let's say somebody wanted to swap $10,000, well, they would be paying you 0.3% of $10,000 is 30 bucks. That's what would happen. So if someone swaps from one side to the other, you get $30 of the coin and there's a bit of impermanent loss, but don't worry about it. Assume that we eventually get back to the same ratio. So what I mean by that is just assume over time we eventually kind of mean revert and that you don't have much impermanent loss, okay? So we're dealing with these two ratios. So when you get this little $30 fee, it compounds every day and you can get a yield estimated by the end of a period, like 12 months. And remember, I have this website here, uniswap.fish. It's really cool. What it can do is you can give it some estimates, some coins of a pool, and it can tell you what your estimated yield is. So before I continue, I'd like to reiterate to you, okay? So when it comes to with yield farming, all right, some few things that you need to know. And trust me, what I'm about to relay to you will save you so much money, time, and anguish because I've read a lot of Medium articles. I know the conclusions, okay? So even though Uniswap v3 exists, Uniswap v2 is actually better for LP'ers. This is going to flip your mind out. All right, so I'm going to show you some information and it's going to absolutely blow your mind. So Uniswap v2 lets you only do a simple ratio. You evenly spread out your liquidity. So basically, when it comes to a spread, when it comes to the Pulse and PulseX, for example, you basically have to provide liquidity all the way up and all the way down. The full range. It's called full range, okay? But when it comes, this is V2, okay? V2. When it comes to Uniswap v3, okay, Uniswap v3 lets you compact it. So you might only do a big fat chunk of liquidity right here. And also, if you really want to do, you could do like a big fat chunk of liquidity, like a big zone down here. So you might say, wait a minute, V3 is more flexible. You can give yourself way more opportunity to buy a specific area in a coin or provide liquidity up at a certain resistance. I mean, this is a fantastic thing. They did studies, they checked out the statistical information, and guess what, friends? You're going to flip out. V2 actually made more money on average. Now, in V3, you know who makes the money? It becomes just like trading. So in V3, so I want to tell you this. In Uniswap V3 style, the top 5 to 10% made all the money. The bottom 90% are pooped, wrecked. This is the truth, okay? This is the truth. I'm not making this up. So it's just like leverage trading. It's just like trading itself. Over time, the top 5 to 10% on the pyramid, they make it, but the bottom 90% end up getting pooped. Okay, and you're probably wondering, how is that? And that's because, okay, when everybody's playing a range, everybody thinks they're a genius. That's why. Okay, so if you have a range here, let's say you have a spread here that's moving up and down like this, right? This is your spread. You provide liquidity. What people will do is let's say it breaks up. So you know how we've got this triple top here. Let's say the spread starts breaking up. What most people will do is, right, if they micromanage their liquidity, is they will hit this point and they'll say, okay, I will then withdraw my liquidity. I'm going to pull both sides. So they might say, well, you know, this Pulse and PulseX, it's starting to break up this ratio and I don't want to play with it anymore. I'm just out. So they'll take some impermanent loss and they exit. This is the interesting part. In theory, it sounds like it's the right thing to do. I know, in theory it does. But over the long term, the best thing to do is to literally just leave it. You might say, why? Why is that? And that's because of this, okay? Let me tell you something. Because on average, when these spreads blow up and blow down, there is volume and activity. And do you remember that liquidity fee we were talking about, how you get 0.3%? It actually builds up slowly every day, such that, guess what? When crypto does the mean reversion thing, which it always does, the people who left it the whole time end up benefiting the most. But they had to delay their gratification and they didn't have to lose their mind, right? If you were able to have the courage, the balls, the steel ovaries, the sultanas to sit there and just let it go, you end up coming out ahead. Isn't this fantastic information to know? So if this is a bit confusing to you, I want you to know, remember friends, okay, there is Uniswap v2 and there is Uniswap v3. Uniswap v3 gives you more control. Uniswap v3 lets you set a liquidity range, okay? Uniswap v2 is a full range. It goes infinite up, infinite down. Uniswap v3 lets you clunk it up, but the statistics don't lie. On average, v3 people actually get destroyed. It's almost like if you're a kid in a candy store and you see 100 flavors of candy, 100 flavors of ice cream, you don't know which one to pick. There's too many options. But when it comes to just V2, it's one button in and out and you say, okay, I'm just giving it 12 months. Now, this is where it's going to get interesting because I'm going to use some quick examples here to show you. So remember this website, uniswap.fish, really cool. On this website, you can click on the network. So you click on Ethereum because it has the most volume and we can select pairs here. It's very fascinating what we can do. And what I've done is, right, I'm going to show you right now. I'm just going to show you Ethereum and USDT. So, right, just to reiterate, okay, this is a poopy pair because half of it is fiat. But I'm going to just show you an example of how people get destroyed. Because this is what happens, friends. If you are in, let's go back to this example, okay? Let's delete these. If you are in ETH USDT, people feel safe because they believe they have ETH on one hand and they have USDT on the other. So why do they feel safe? It's because they know that if the price of the, because you're basically in ETH USDT, right? If Ethereum goes down, then they feel okay because they are collecting more Ethereum in their Uniswap pool. All right, so just remember, when you are providing liquidity like this, so this is the liquidity, okay? When you're providing liquidity, ETH USDT, as it goes up, you are giving away your Ethereum, you are getting more USDT. As it goes down, you are giving away your USDT and you're collecting Ethereum. That's what happens, all right? Because it's a ratio and it's a spread of just how the formula works. Now, I don't want to get you too confused, so just stay on track now, okay? So ETH USDT, people think, wow, you know, it's pretty stable. If it goes down, well, I wanted to collect more Ethereum anyway, because that's what happens, right? As Ethereum's price goes down, you're collecting more Ethereum based off the liquidity, and you're providing fees. This is where it gets very interesting. So what you can do is you can select the fee here, or the fee tier of what you want, okay, based off Uniswap v3. But I want you to know that don't worry too much about this, but we'll just select the most common one they had. It said bet 71% select this 0.05%. See, you might ask me, why don't you select a higher percent? So what I'm doing here, these are the different fees you see here. Now you might say, oh, why don't you select the higher fee? The problem is, if you select the higher fee, okay, basically this is what the book looks like. You are up here and down here, okay? This is your bid and this is your offer. This is your offer, okay? This is your S for your sell offer, okay? Your bid and your offer. The people who are degens, the degen market makers, they are inside you. They are literally here. They have their buyers here and they have their sells here. So what happens is, as people buy and they sell, they're going to collect the fees in the inside up and down range. But only after it makes a big move do you get filled. Okay, so but guess what? You're going to get filled less often. All right, so this is where we're coming from when we should select the highest one that they speak about, okay? So watch, if we continue and we just select the highest one, it's going to get interesting. Have a look at this, okay? The yield is absolutely atrocious. So what I'm going to do is, see this amount here? It doesn't really matter what number you choose, but I'm just going to put $100,000 just to make a nice round number. Look at this. See this? We're gonna zoom in here so we can see the actual APRs, because now we're gonna see something juicy. Look at this. Do you see this yearly APR? It is 37%. Here's the problem, okay? Down here, we have not selected a full range, all right? This is fake. So do you remember when I did my example here and I told you that V2 actually made more money than V3? Well, here's the thing. V3 lets you act in a tighter range, okay? So this is V2 is infinite range, and then V3 is a thicker range, all right? Thicker range. And then you pull basically this is V2 on the left and V3 on the right. V3 theoretically gives you more fees to play around, because if people are hitting up and down, you're like, oh wow, I'm getting more fees, sweet, sweet, sweet. Okay, and this is where people get even more confused, because if you go back and you see these numbers, okay, you get to see that the monthly rate the yearly rate is 37%. You might think that's great, all right? But this is in a tight range. So the real way to calculate what it is, you got to select full range. This will mimic V2, and you think, uh-oh, this is atrocious, 1.68%. What's going on here? So this is a terrible yearly rate to do that. I'll tell you what's going on. What's going on is, you might sit here, because Ethereum is such a popular thing, a popular product, okay, to trade. You might sit here with your long range, but people are competing against you with much tighter spreads. So this is the funny part. The people in between, okay, this is what it actually looks like, okay? Out of 10 people, one person is making 100% APR, 9 people are making 0%. This is actually what happens. I'm not joking, this is the real number. So one person, so when I mean my person, I mean a quant fund, a hedge fund, someone out there who has a very good statistical modeling about how they can predict the movement of Ethereum up and down, okay? Because maybe Ethereum's price goes up a certain range, they pull their liquidity and they put it into a new range. Okay, they're constantly mimicking this, paying the gas fees. Don't worry about this, right? It's just very interesting to see. It's winner takes all. So as the prices go up and down, everyone's making money, but then it pulls, it goes up a certain distance, and 1 out of 10 people are making the right decision, whether to pull or to leave it there or to add more. So this is where it gets nasty, okay? And here's the sad part. The sad part is, because this one person is making all the money, they take away from the 9 people who are also competing. And also, if you try to do Uniswap V2 on ETH USDT, you get nothing. That's why this number is only 1.68% for the year. So basically, if you left $100,000 in there, you let it go in the liquidity pools, you'll only get you'll get $1,600 by the end of the year on average based off this volume. That's on average, okay? Hopefully we have higher volume periods. So this is disgusting, isn't it? It's disgusting, but that's what happens when Uniswap, it's a beautiful creation, but it has screwed up the game more for the little guy. It allows these big market makers to come and basically make spreads tighter, but then they compete with each other. They're all gambling with each other, all right? And if I bring it back to just a normal range, look at the APR is 37%. So effectively, this is, remember, I unticked full range. Now it's people guessing the range here. So they're trying to guess where it's going to trade between in like a 6-hour, 12-hour, 1-week period. And you can see the APR jumps up huge. Isn't that fantastic? You're making 37%. But remember what I said, it's actually winner takes all. So I know from the stats, because I've shown you, I've seen Medium articles, I saw people compile this. It's literally the guy on top kills it, everyone else gets destroyed, because it's just like trading again, because there's one person who's got an edge over everybody else. And now for some fun, I went and I entered the HEX USDC pool. This is going to be very interesting, all right? So the HEX USDC pool, because HEX's liquidity is thinner, okay? HEX's liquidity is thinner. We will be able to get higher numbers to be compensated for this. But now it becomes even more interesting, because $100,000 in the year, you might be flipping out here. You might be going, whoa, $100,000 earns me $124,000. Aren't I a genius? Hold on there, little Timmy, little Jimmy, and of course, little Bimmy. I am rolling my tongue off. That's how excited I am to tell you. I hear this so many times, friends. I can't tell you how many times I hear this, and people, unfortunately, get it wrong. So this is what's actually happening. So someone here has, so your 100K total, right, is 50K into HEX, 50K into USDC, okay? And I have the logos here for you nice and neat. So, all right, at the end of the year, remember, we're looking at this example, okay? At the end of the year, you're going to look at this and think, whoa, I will have so much more, but it's not so clear cut because that $50,000 is staying in USDC. That's what it is, all right? It's staying in USDC. You could, this is the answer, right? You could take that USDC and buy 50,000 HEX, more HEX, all right? That's the difference. The difference is your opportunity cost. Because think about this. In 1 year, that 50K has only helped you create 2x your money. And you will have impermanent loss, by the way, on the upside. That's another thing as well, because you're providing liquidity, you're having impermanent loss. So think about this. You are basically taking the opportunity cost because you can't go back in time if this happens. So HEX, whatever price it is, let's say it's like 1 penny, right? Whatever it is you get. You thinking in 12 months from now, is this going to be more than 2 pennies or less? Because it's so thin and it's so easy to pump this thing more than 2 pennies, right? More than 2x from where it is. You have to think long and hard before you commit to something like this because you will not be able to go back in time and get these cheap prices, all right? And the volume will only come if the prices are moving up. That's another catch-22, all right? So even though, yes, it sounds great, yes, if I provide liquidity, I do really well. But you have working capital here in USDC that could be doing so much more with your money instead of sitting there and just contributing to a 2x. Because if HEX's price keeps rising, you will be losing more and more and more of your actual HEX stack. So even as you can see here, right? So theoretically, at the time of recording, it'd give you like 100K would give you like 11.4 million of this EHEX. But you might find if it goes up high enough, you're down to like 7 million. You're down to 6 million. So that is a really important aspect to take on board. And even if you said, wait a minute, what if I don't do the HEX USDC pool? What if I do HEX Ethereum? Okay, well, obviously here is where there's also some truth coming your way because HEX versus ETH, sure, ETH is going to kind of go up, but its upside is completely different to HEX. Because yeah, sure, you might enjoy a 90% APR by the end of the year if it works out and the volume continues, right? Yeah, you think you're going to enjoy that, but it's literally the same game. Because with your USDC, you might have Ethereum instead. And I've got the logo here for you. So it's the same game because you might find the same thing happens. You might find in a year, sure, ETH has gone up, but how much has it gone up? If maybe Ethereum's up plus 50% in a year, that's still nothing compared to what HEX can do considering it's down 98%, right? So this is still opportunity cost again. So yes, on one hand, you do have this safety in your mind thinking, okay, well, nothing can ever really go wrong and I'm kind of earning this passive income. But on the other hand, you are absolutely not taking the full advantage of the depression zone. And of course, friends, I just want to blow your mind even more. So this HEX Ethereum, the APR of 90%, this assumes you are a professional Uniswap v3 provider, okay? You have to go down and click this full range. When I click full range, it makes it Uniswap v2. Look how much the rate drops. Now you're down to 15% for the year. You see how tiny that is? You're like, crap, man, 15%? Think about that. How easy is it to make 15% if you deploy part of your Ethereum out there? Like, you just know the buying in the depression zone, man, you're here for at least 5x, 10x, right? 500%. If that's 1,000% on 10x, 15%. So that's your opportunity cost with staying in these. You know, I can go back to the HEX USDC and I'll put it on full range. It drops from, this is 124%. It drops down to 83%. Of course, remember, because the USDC is not going anywhere. It's just going to be worth $1 USDC, $1 in 12 months. And of course, this sounds great. When you're in a bear market, you want this certainty and this kindness and this friendship. But when you're looking at something like this, exiting out of a depression zone, you know things can fly. And so we reach our conclusions now, because I'd like to just put these in a nice, simple format for you. So you got your fluffy slippers on, you got your straight posture, you're drinking your beautiful cold glass of orange juice, and now you want to know, actually, what's the truth? The truth is that, okay, Uniswap v2 is actually better for LP'ing, so liquidity providing, okay? It's actually better. And number two, yield farming is not actually a path to riches, and you have to always consider opportunity cost with each leg or side of your LP, okay? Because you may be taking on safety returns at the expense of missing out a giant moonshot. So even as little as plus 500%. So this is something to always consider before you go and do any of these liquidity farming, yield farming, whatever it is. Because if you keep chasing these short-term carrots on a stick, you are going to miss out on what crypto is really about. You will regret it. Because you think, just by looking at these, friends, that you think, wow, I just do this yield for 2, 3, 4, 5, 10 years and it's going to be great. But we know how crypto is, man. The volume in crypto is a freaking scam itself. The volume only picks up for like 1 year and then it's dead. You saw it. The volume goes up for 3 months and then it dies. And then it goes up for another 3 months and then it dies. And then you get to the bull market and it runs up for 6 months. And then suddenly now we have decreasing volume for the next 2 years. That's exactly what we saw in crypto. So these volumes that we see, the volume trajectory that we see, like if it follows the natural crypto path, friends, it's absolutely shocking. It's shocking what you have to experience. So don't think these fees are like these great. This is literally just a snapshot of 12 months. But what do? We think, wow, if I sit in this for 5 years, this protocol is going to look after me and I'm going to get all the fees. No, you won't. It gets more competitive over time and you're really going to regret. If you're really going to regret it if you left your money in fiat and you did not take advantage of the depression zone. But luckily for you, you have a friend like me to tell you what to do. Like, subscribe, press the bell button and all. Tell mom and dad we're still going to make it and that yield farming is not as good as it seems. Catch you in the next one.